Well, dear students, it's time to talk about brokerage accounts, different account types and thwack annuities. And with warm regards to Rodney Dangerfield, we tell this joke. I tell you, this stock market is bad. It's even worse than a divorce. You lose 50% of your net worth, but you still keep your spouse. I don't think it's actually a Rodney Dangerfield joke, but it's certainly in the style of his jokes. And have you ever wondered why they call us brokers? Slide number 2. What are the different types of brokerage firms? Well, first there were the full-service brokerage firms, and you paid dearly for their services, and some of them are still around, like Merrill Lynch and Morgan Stanley. I'm sorry, Merrill Lynch and Morgan Stanley. I think now it's called Merrill Edge, I think. I don't follow them too much. Then there were the discount brokers starting in the 1970s that have coalesced around just a few companies. The largest, most notable is Schwab. But there are a few others like LPL and A.G. Edwards and Edward Jones. And then there are the deep discount brokers, the internet brokers that emphasize technology to reduce brokerage costs dramatically. What can you expect to pay for each? What kind of service can you expect from each? Well, the full-service brokers are going to treat you really well, take you to the golf course, steakhouse, send you a bottle of wine on your birthday, and really hit you with huge fees. Some of the discount brokers might do the same. They might hit you with those assets under management fees, which make them very wealthy and keep some of the money off the table for you. Remember, I'm a stockbroker. I can say true things about brokers. And then the deep discount brokers really don't even want to talk to you. They want everything to be done on the internet by you or yourself, although they will offer some services for a fee, my understanding. Yes, indeed. So what were commissions? Well, full-service brokers used to be, and still are, I assume, but now, again, everything's assets under management now. Commissions are a bad word. But it would upwards of $100 or more per trade. The discount brokers in the 70s started at $45 and then down to $29 and $19 and $13 and $9 trade. And the deep discount brokers started at $5 to $10, but now a few companies in the last several years ago, experimented with $0 commissions, and they failed. One failed. The other one, I think, now charges $5 a trade, but maybe they've joined the crew because Robinhood was very successful in getting the younger folks, because it's kind of like a video game, involved in trading. And if you still think you're trading for free, just stick with us. The mutual fund companies now offer brokerage services. Now, it's not the same company, but it has the same name. I forget what it's called. Fidelity Brokerage Services, Vanguard Brokerage, whatever. And they allow you to buy their ETFs with no commissions. Very cool. So very good marketing. That was Fidelity, and Vanguard has followed suit, and I'm sure there's others. How can a brokerage firm make money on $5 a trade or $0 a trade? Remember, every time, first of all, the New York Stock Exchange and the NASDAQ are taking their cut, and you got to keep the lights on and the internet service. You got to pay the people. What's going on here? Do you remember this slide from Chapter 3? Scott Trade, which is now owned by TD Ameritrade, which was now bought by Schwab. Scott Trade Incorporated receives remuneration for directing orders to particular broker-dealers or market centers for execution. Such remuneration is considered compensation to the firm, and the source and amount of any compensation received by the firm in connection with your transaction will be disclosed upon request. They're getting a kickback. You're paying more when you buy and you're getting less when you sell. Now, as we've discussed in detail, the amounts that these, Virtu and what's the other one? Ken Griffin, Citadel are taking are minuscule. Trading costs have gone down immensely, but they're charging you, folks. And don't think you're trading for free. The more you trade, the more they make, and that's why they want to turn it into a video game so you do it every day. Ugh. What are alternative methods of paying your broker? As the competition for your business has gotten fiercer, the methods of charging investors for investment services have gotten more creative. Many years ago, Merrill Lynch experimented with just charging $3,000 per year with unlimited training. They don't have that program anymore. There are many other methods. The most notable, as we've discussed, is the assets under management fee. But the new modern day go-go way to customers, charge for brokerage services is called assets under management. Assets under management is what many brokerage firms want to charge you now, and many of them they only want to talk. It used to be they wanted you to have 50,000, then it was 100, now it's 500,000 or more. Do you remember the F shares, the I shares, the FI shares in Chapter 2? Yeah, instead of charging you commissions, they're going to charge you 1 to up to 2% wealth management fee. Oh, we're not your brokers, no, we're your wealth managers. And these types of programs are now being pushed by all the major full-service brokerage firms. And I told you my feelings on them. You, as an investor, are going to wind up spending a whole lot more, assuming you're not a buy and sell kind of person. If you are, then yeah, then of course this is going to help you not pay those commissions every darn time you buy and sell. But if you're a buy and hold, oh my goodness, you're just going to get raped. The latest wrinkle, which is now about 15 years old, in the new performance-based wealth management program is performance-based wealth management. Only pay your advisor when you make money. The advisor receives 10 to 20% of your earnings when you make money, but they receive nothing when you lose or do not make any money. In other words, every quarter they would do it, your investment portfolio goes up, they're going to take about 1 or 2%. I'm sorry, 10 to 20%. Yeah. Now, only on the earnings, folks, not on the whole thing, but still, it's just a variation of the way hedge funds charge their shareholders, which is even worse. It's currently marketed to high net worth investors. And the first time I saw this was Dunham and Associates, and it was right before the Great Recession, right before the global financial crisis. And I'm sitting there, I got my suit on, I'm with the pass in as a broker, a real broker. I don't know. Whatever. And I'm thinking to myself, next bear market, these people are going to be sucking air because they're not going to be getting any money. Yeah, they've now altered the fee structure so that they charge much less when your account does not gain instead of charging nothing, but they got to live, right? Although it may sound tempting, only pay my broker when I make money. The reality is that you have the potential to pay far more for your investment services using this method. So I'm not a big fan of this method. Okay? I think pay the commission, be done with it, and don't trade, right? Invest, don't trade, says Mike Gitlin of Capital Group American Funds. He's the CEO. He says it in 3 words. Invest, don't trade. Brilliant man. Okay, what about anti-brokerage firms? You can go with dividend reinvestment plans. You remember these from Chapter 3? Some are totally free or very close to free. The one we had through Sempra Energy, San Diego Gas and Electric, would charge us every once in a while 6 cents or 3 cents. And of course they don't. San Diego Gas and Electric isn't taking care of this program. They contract with a company to do it for them. And now most brokerage firms allow you to say, okay, I want these dividends, instead of sending them as cash into my account, reinvest the dividends. Okay? They are not perfect. How would you like to have to sift through 18 different statements? But there were companies, I'm not sure if they're still in business, but they would charge a monthly fee to allow you to keep all your drips in one place. And I think they have gone out of favor because most brokerage firms now say, oh, you want to reinvest the dividends? Fine, we'll do that for you, usually free of charge. Cool? I'm a big fan of dividends, you know that? And I really love drips. Yeah, it's a great name too, right? Because it lets you fully earn the full total return, fully amortized total return of that stock by investing in dividends. It's like a mutual fund, basically like a mutual fund. That's how mutual funds work. Okay, so now let us turn our attention to the different types of accounts. This is a graphic that is trying to show you that there are basically 2 different types of accounts. Taxable accounts and what the IRS calls tax qualified accounts. And sometimes you hear people call it a regular account. And there are various types of tax qualified accounts. The most notably are retirement accounts, but then there are educational savings accounts and there are health savings accounts, which actually have gotten more popular now because there's some really cool things that they can do. When you get a taxable account, you have no limit on what you can put in the. It's supposed to look like a bin, like a bolsa, like a bucket. My apologies, I'm not a very good graphic artist. And you can put anything in there: stocks, bonds, mutual funds, but real estate, cash, options, futures, shorting, margining. Oh yeah, stay away. There's no limit on contributions, no limit on investment types, and you pay taxes every year. You're going to get a 1099, various types to pay the taxes on the earnings, dividends, rent, interest payments, capital gains that you received that year. Now, when you have a tax qualified account, it works very differently. There are strict limits on contributions and limits on investment types. So even though there's a few others that you can stick in here, let's just stay with the biggies: stocks, bonds, cash, treasury bills and the like, and mutual funds. The cool thing about these is your contributions are either tax deferred, that's called pre-tax, and you don't pay taxes on the income that you put into these things that year, you get a tax break now, or they are tax-free once you retire. That's very cool. That's often called the Roth option. So we don't want to get into too much detail on these. We spend more time in the BUS123 Principles of Money Management class. But if you do have any questions, you know who to contact, right? I can talk about this far longer than any reasonable person would ever want to listen. But let's go through the major examples quickly. Let's go to the next slide. Thank you very much. The pre-tax versus the post-tax. The pre-tax, sometimes called before tax contributions, are 401ks, 403bs, 457s, 401as, what others? There's a few others. And the names come from the Internal Revenue Code, where it tells you if the company does this and you do that, yay. You can put your money away, get a tax break now, and pay taxes when you retire. The traditional IRA works for everybody. If you have earned income, doesn't matter, you can have a traditional IRA. And then there are a few of these wrinkles: the SEP IRA, the Simple IRA, the KEO, for either small businesses or self-employed. They all work basically the same way. You get a tax break now. Your deductions your contributions allow you to deduct income from your income tax, and you get a tax break now. The money grows tax deferred, and then you pay taxes in retirement, which makes sense usually because most people are in a lower tax bracket when they retire. And if you're not, congratulations. If you're pulling so much money out of your retirement, you're right, exactly. The other one, which is newer, starting in the late 90s, is the post-tax contribution, after-tax contribution accounts. And the most popular is the Roth IRA. For almost everyone, there's a wrinkle. Hang on a minute later. There's a limit on how much you can make and then still contribute, but you can get around that with what's called the Roth backdoor. Then there are 401ks and 403bs. Well, you put them in quotation marks because the IRS doesn't call them that. They just call them 401ks, 403bs with after-tax contributions, post-tax contributions. You don't get a tax break now, but in retirement, oh yeah, tax-free in retirement is a golden opportunity. I'm a big fan of the Roth IRA. So the individual retirement arrangement, is that really what it stands for? Yeah, everyone calls it an individual retirement account, but the real name is individual retirement arrangement. It's the most popular personal retirement plan. It's been around for decades. And now it's referred to as the traditional IRA to make sure you don't get it confused with the Roth IRA. Anyone who has earned income can contribute to a traditional IRA. There's a little bit of confusion because some people think, oh, you can't do it. You make too much money. No, that's not the case. Doesn't matter how much money you make, you can put money into the IRA, traditional IRA. Now, where's the wrinkle? Contributions are normally tax deductible unless you have a retirement account at your place of employment and make over a certain amount of money. it doesn't matter whether you contribute to the retirement plan. If they have a retirement plan, and you make over a certain amount of money, you cannot deduct your contributions. You can still make your contributions, but they're not deductible. That means you have to keep track of how much you put in after taxes so you don't get taxed twice on the way out. The investment, as we said, grows tax deferred. And once you reach 59 and a half, you can take the whole thing out. There's a couple of ways you can actually take some money out beforehand, but let's not go there. Mandatory withdrawals begin now at age 73, and that's probably going to be going up over time. It used to be 70 and a half. I don't know why they got these and a half things, but that's what they got. And then the IRA has many cousins, the 401k, 403b, 457, 401a for public organizations such as school districts and college districts. The SEP IRA, the Simple IRA, the Solo 401k, the SAR SEP, which I think is gone now. You can be grandfathered in, but it's gone. The KEO, which I love that name, KEO. And then the Roth IRA, which is my favorite. They all work very much like the traditional IRA, except for the Roth option, right? If you put money in after tax, post-tax contributions, then you get to take it out later on in retirement tax-free. And the earnings. Oh, that's such a cool thing. So let's see an example. You contribute via your paycheck $100 to a 401k. Now, we're not even discussing whether or not your company matches that, puts $50 in or $100 in on your behalf. That's really cool. Think about it, folks. Who's going to give you a 50% return or 100% return on your money in one day? Only your boss. Why? Because they want you to go away when you retire. They don't want to deal with the traditional pension plan called the defined benefit plan. These are called defined contribution plans. And it makes sense because more and more today, we don't work for the same company for 30, 40 years. We bounce around. And so it makes sense to take your retirement plan with you. Now, having said that, right, you want to make sure that you contribute prudently, with an eye toward long-term growth and income, and you should do very well, unless the world ends. Anyway, so you put in $100, and if it's before tax, then depends on your tax bracket, which we're not going to get into that stuff here, and they take 121 principles of money management. But let's say you're in the 25% tax bracket, and you're in the 8% California bracket. Your government subsidy is $33. Well, not really. They just take 25 fewer dollars out for withholding for the feds and $8 fewer dollars for the state of California. And so you wind up seeing your take-home pay only reduced by $67. Cool. The whole $100 and maybe $150 or $200 goes into the account. Okay, Payano, what's the catch? Well, you pay income tax on any amounts withdrawn in retirement, but people in retirement are usually in a lower tax bracket, and if not, congratulations. I hope all my students, all my clients, and myself have that horrible affliction in our golden years of taking too much money out of our retirement account. Plus, right, you give this money a little kiss, send it on its way, let it do its thing for 30, 40 years, and then come back in retirement. Now, what if you take the money out before retirement? Well, there are some cases where you can do it, but you're going to have to pay the income tax. I mean, that makes sense. You didn't pay on the way in, but you may have to pay a 10% penalty. Now, the IRS doesn't like that word. They call it an additional tax. We call it a penalty. But there are some exceptions. First-time home purchase, higher education, medical disability, financial hardship, which used to be very hard to get the IRS to accept, but since COVID, they've been a little bit more lenient. So that's the pre-tax, before-tax contributions. What about the after-tax? Roth IRA, the Roth 401k, the Roth 403b. Again, put it in quotes. You contribute to a Roth IRA $100. Now, what does the feds do? What do? No, they don't give you nothing. The California, no, they don't give you nothing. In other words, you see your disposable income reduced by $100. Oh, well, why contribute to a Roth IRA? Here's the answer. Because a Roth IRA is so cool. Tax-free in retirement is a golden opportunity. No other investment account option comes close, in my humble opinion. You could come up with some weird scenarios where it might have made more sense, but still, I think they're going to get rid of them eventually. You can, if you're grandfathered in, great, but other people, no, 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 because there's going to be so much money that the feds can't get their paws on. Some people say don't trust them, they'll change the rules. Oh, we'll see. Old people vote and they have canes. And here's a cool part about the Roth IRA, not the Roth 401k or Roth 403b, but the Roth IRA. You can withdraw the contributions at any time without penalty. Why? Because you already paid taxes on the contributions, right? So this makes the Roth IRA also an excellent intermediate term investment account. Purchase of a house or other high ticket item, great for college expenses because they are currently not used in financial aid calculations. Now, my understanding is that private universities will use what's in a Roth IRA because they figure, okay, you can take the contributions out. But as the form is now, the FAFSA form, FAFSA form, they don't ask how much is in your Roth IRA. Yeah. So when people say, should I go open up an educational account for my son or daughter? I say, have you invested in a Roth IRA yet? And they go, no. I said, that's, I think, the trick you should do. Yeah, I think so. Unless you got a whole lot of money and you don't know what to do with all of it, then yeah, educational savings accounts are cool. By the way, if you use the educational savings account, they take away the ability to take those tax credits, and for every dollar that's in those educational savings accounts, they reduce any financial aid that you may get by $1. So yeah, I don't understand why they do that. It's kind of nasty, but that's what they do. Well, slide 17. Okay, but a Roth IRA is not for everyone. Yes, it is. You just have to learn how to navigate the paperwork. See, there are limitations on Roth IRA contributions. Only single taxpayers with an adjusted gross income of $150,000 or less in 2025, and married couples with an adjusted gross income of $236,000 or less in 2025 can fully contribute to a Roth IRA. And if you don't qualify, congratulations, because the idea was not to let very wealthy people take advantage of a Roth. However, and these numbers go up every year with inflation. However, you can still contribute to the Roth anyway. Well, if you find that you've made over the limit, or you knew you were going to go over the limit, you can recharacterize the contributions into a traditional IRA, which doesn't have the same limitations for income, before you file your taxes, and then you convert the traditional IRA back into the Roth. What? Recharacterize. That's the verb the IRS uses. Yeah, but there's some, you have to talk to somebody before you do this because there's some gotchas that could get you in trouble. But who voted for these people? What a crazy thing to... Oh, yeah, we voted for them. Yeah. Yeah, I know. Everyone can agree that the tax law is hopelessly broken. Nobody can agree on how to fix it. Slide number 18. Here are the contribution limits for 2024 and then 2025, and they haven't changed, but they go up over time. So if you're watching this before April 15th, 2025, you still have enough time to contribute for 2024. And of course, you can also contribute for 2025. If the maximum amount you can contribute is either $7,000 if you're under 50, or $8,000 if you're 50 or over, or the lesser of your gross salary. Now, most people are going to make over $7,000 or $8,000, right? And then for 2025, you have until April 15th of 2026, right? And if your spouse doesn't work, you can contribute on their behalf, assuming you make enough money to do for both, right? And as we say, the contributions limits rise with inflation, and we're going to see that when we take a look at the next slide for 401ks and 403bs. So here's the next slide, slide 19, for the 401k and the 403b contributions, and you can see them rising with inflation because the increments are much larger. Yeah, $23,500 in 2025, and if you're 50 or over, $31,000. Of course, you have to make at least that much money. Now, if you do make, say, $23,500, you could put the whole darn thing into a 401k or a 403b or 457. And there's a loophole in the law that is still there that allows you to, if you're in the public sector, to contribute both to a 403b and a 457. 401ks are for corporations and businesses and the like, private as we call them, even though they might be a publicly traded company. But people, students, Southwestern College employees, firefighters, public servants, hospital workers, often have a 403b or a 457 or both. And you can contribute to both if you make that enough money. Pretty amazing. So for example, if you have if you're married and you have a double salary, you can take one of the person's salary and just dump it all into the 401k, 403b, 457 and live off the other person's salary. Now, I have said on many occasions that if you did this in your later 20s, early 30s for 5 years and then never touched it again, you'd never have to put another dime in your retirement account, which I hope you do anyway. But I've had 2 couples come up to me and say, I don't believe you, I don't believe you. So I said, come to my office, I'll show you. And now, come to my Zoom office. And sure enough, it works. You can contribute a ton of money in your early years to your retirement, and assuming the world doesn't end, invest prudently, wisely, with an eye toward long-term growth of capital and income. And assuming the world doesn't end, you should do pretty darn well. Slide 20. Roth 401k, Roth 403b. Well, that's not what the IRS calls them. That's not their real names, but that's what everybody else calls them. The IRS just calls them 401ks, 403bs with after-tax contributions. First, your employer has to offer it, and now they're allowing it for simple IRAs too, starting in 2025. Okay, so what do? You tell your employer, instead of taking pre-tax money, which reduces your taxable income in that year and gives you a tax break now, you say this is after-tax money, and you don't get a tax break now, but you get a tax break later in retirement with the contributions and the earnings being tax-free. Very cool. However, you cannot take out the contributions before retirement like you can with the regular Roth IRA. No, they're stuck there, right? And any employer matches will continue to be pre-tax. So it gets really tricky. You have to keep track of how much is after tax and how much is pre-tax. It's a great option if you're in a lower tax bracket and you really don't need the tax break now. However, in my humble opinion, unless your employer offers the matching contributions, I prefer the regular Roth IRA because it's more flexible. You can use it for college if you need to, or maybe buy a home or something like that, the contributions. But of course, if your employer matches, that's a no-brainer. You take advantage of the free money there. And slide 21, there are tax credits for low-income earners. Now, I don't know about you, but for married, $59,250 for head of household, $79,000 for a married couple, almost $40,000 for single. That's not that low, in my humble opinion. I mean, it's a pretty good salary. It's based on your adjusted gross income. And if you do your own taxes, don't forget this. So it's either 10%, 20%, or 50%. So for example, you put $50 a month into a Roth IRA, that's $600 a year. The feds might give you back $300. Pretty darn cool, right? If you do your own taxes, don't forget this. If you do have somebody do them, make sure you tell them that you put money in a Roth or a 401k. Well, they'll see that. They'll see it on your W-2. Tax programs such as TurboTax and Tax Act and H&R Blockheads, they, what is it called? Tax at Home? They handle these really well. They're going to just ask you, did you put money in a 401k? Did you put money in a Roth IRA or a traditional IRA? And then they'll, if you are eligible for the retirement tax credit, they will automatically do it. If you don't take it, though, is the IRS going to call you and say, hey, Fred, I see that you didn't? No, they're not going to do that. No, you have to ask for it. Now, we've mentioned these bad boys throughout the semester from time to time, annuities. Well, in its purest form, annuity just means a stream of payments, a stream of contributions, whatever. But annuities are insurance products. And of course, we never trust an insurance company with our investments. If you need insurance, like life insurance, you have kids, you have health insurance, you need health insurance, car insurance, household insurance, yeah, go see an insurance agent. Remember, I'm a licensed insurance agent. I'll tell you the truth. But these annuities, they have this siren song that makes them tempting. But typically, they're really not very good, folks. They're not very good. And we're going to see an example of that in the presentation, in an ancillary presentation in this chapter. An annuity is a life insurance product designed to provide a guaranteed income. Now, the options include income for a set number of years, 10, 20, 30 years, or the one that's most popular is the life income option for as long as you live. Or you could set it up for as long as you and your spouse or other dependent lives if he or she outlives you. Now, doesn't that sound enticing? We're going to guarantee. We're insurance companies. We're the invisible bankers. We don't go bankrupt. Very few. I mean, there's been a few, but it's very few and far between. We're going to guarantee that we pay you this amount of money for the rest of your life. Right. What do we know about guaranteed returns? Right. We're going to guarantee that we screw you over for the rest of your life. Because I got to tell you, folks, if you don't have any ethics, you get your life insurance agent license, you can sell these things and make a ton of money because the commissions are very, very generous. The amount you get, whether you choose the 10-year, 20-year, 30-year, or life income option, is based on your age, which of the options you picked, how much you've contributed, how well your annuity investments, if any, have performed over time. There are two types of annuities. There's the fixed annuity where we're going to give you 3% for the rest of your life, whatever. They just invest in bonds. Remember, bonds pay 4 or 5%. Where's the rest going? You know where it's going. Variable annuities allow you to invest in mutual funds, and you can invest in stock and mutual funds. Yeah, but then they're going to take 2 or 3% on top of what the mutual fund takes from you. I've had the wholesalers, they're called, the representatives from the companies come and talk to the registered representatives, the financial representatives, whatever you want to call us, stockbrokers. And there's an old saying: if you can't say something nice, don't say anything at all. So I just keep my mouth shut. But they're not very good. I mean, some of them are okay if you already have your 403b, 401k fully funded. You have a Roth IRA fully funded. You got plenty of money afterwards. And they're for people who really have so much money they don't know what to do with it. Okay, go ahead and buy an annuity. But even then, I don't think they're a good deal. I once, and I talked to other insurance agents, other brokers, and about them, and I almost got in a fist fight. Well, I didn't. I was going to run because this guy was ready to hit me because he was so angry because I was picking apart his baby, his annuity. Yeah, and I, I'm a coward's run in my family, and his colleagues, calmed him down and said, you punch him in front of all these people, you'll go to jail, you goofball, lose your license. So he came over later on and apologized to me, and I said, well, that's all right. Everybody's selling what they're selling. And like, all right, buddy. So what are the advantages and disadvantages of tax-deferred annuities? Well, they can be funded with retirement account dollars or after-tax dollars. There's no limits on contributions, as there are with Roth IRAs, 401ks, 403bs. You have $1 million, put the whole thing into a tax-deferred annuity. The interest earned is tax-deferred, and you pay taxes on any pre-tax annuity contributions or the tax-deferred earnings when you withdraw them. So the pre-tax annuity contributions come from another retirement account, right? Because that's the way to get them in there. But if you don't have a retirement account, you're funding an annuity with after-tax dollars. So when they go to pay you back, they keep track of how much was contributions. You don't have to do that, where you should do that if you have a traditional IRA or a 401k or 403b, which has pre and post-tax contributions. And of course, as with other retirement plans, it makes sense to take the money, take the hit later on when you retire, because you're usually in a lower tax bracket. Now, what's the downside of these things? As I've already mentioned, they just have sky-high fees. They usually take 1.5%, 3%, 4% I've seen. It's horrible. And that's on top, if you have a variable annuity, of any mutual fund fees. But they offer great commissions for the life insurance agents. So if you don't have any ethics, I'm sorry. And then they usually have very restrictive provisions about how you can take the money out. What they want you to do is annuitize with them. That's the verb they use, which basically says, okay, here you go, life insurance company. All this money is now yours. You pay me a certain amount for 10 years, 20 years, 30 years, the rest of my life. You see, you can't get it back now. You've given it to them. You've annuitized. Usually there's some way to take it back, but they're going to hit you with a huge penalty. Plus, if you do want to get out of these things beforehand, before you annuitize, then there's usually, they call it the surrender charge, the surrender period. I don't know if you remember the Class B shares from mutual funds where, we put in money and then we have this back-end charge. They don't call it a back-end charge. They call it a surrender charge. And it usually goes, 5%, 4, 3, 2, 1 after 5 years. These guys start at 20 years or 25 years. I've seen it as low as 10 years, but usually it's 20 to 25 years. So I'm not a big fan of annuities. But remember, you might find somebody has to make their boat payment, and so we'll sell you a tax-deferred annuity. So to review our choices, there's a regular account where you pay taxes every year. No limit on contributions, no limit on the types of investments. There are retirement accounts that allow you to get a tax break now. Those are the pre-tax or before tax, you might hear them called. Traditional IRA, 401k, 403b, SEP IRA, simple IRA. You get a tax break now, pay taxes in retirement. And then the newer form is the Roth IRA, the post-tax contribution, after-tax contributions, tax-free in retirement. And as I said, I'm a big fan of the Roth IRA. Now, the last one, annuities. High fees, but you can defer earnings as you do with the others. But you're not going to get the best return. Now, what the insurance agents will say is that, oh yes, but what people do is they often panic and they sell at the bottom. We will keep the money for them and they won't panic. And I understand. There's something to be said for that. Say you are going to bequeath a bunch of money to somebody who is going to just blow the money or make really bad decisions. If you bought them annuity when you passed away, or however you did it, you bequeathed it in your will and trust and the like, or while you're still alive. Okay, that might make sense, a spendthrift, but even then, you could set up a trust that gives them a certain amount, 5% a year in perpetuity. So, and I think you'll wind up with a lot more money for them. Not you. I'm not worried about you because you've made it this far in this class. Not to panic, but then you have to pay trust. You have to pay a lawyer to maintain the trust and have a trustee pay the trustee to maintain. You have to have a lawyer to set up the trust, and then you have to pay a trustee to manage the trust. And there are trust companies, banks and the like, that will do it for a reasonable fee. I think it's not that cheap, but it's not that expensive. A few $100s a year. So, thank you very much for sticking with us up to Chapter 18, brokerage accounts, account types, and annuities. And we are ready for our final chapter where we discuss the ultimate investment, starting a business. As always, thank you so much for being in our class, dear students. We are so proud of you. You are awesome.